Yeah, we're going to discuss credit risk today. So we have seen interest rate risk and uh, we'll proceed with credit risk. This is also an embedded risk in a financial institution business, right? That we have discussed the nature of like a financial institution is to lend out money, right? So we keep lending out money, um, and there's of course um, the majority or the core business process of a financial institution. Of course, we could argue that in modern times, we could diversify a bit, right? The um, revenues that could be earned by a financial institution. For example, we could write guarantees. We talked about this several sessions ago. You could write a guarantee. Uh, you could write a performance bond, and you could expect other non-interest incomes or non-interest revenues, but still the credit giving or loan provision is uh, like the core business of a financial institution, right? So lending out money. Okay, so let's go to our slides. Okay, so credit risk, credit quality problems. Um, Again, when if we talk about the financial institution, like big institution or big accord like BCBS, like Basel Committee, right, in Basel, uh, the first accord that we call Basel the first, this actually started in 1988, right? So that was the earliest uh, version of Basel Accord, Basel the First. So in 1988, when they discussed the several pillars of like financial institution, so there were three pillars, and one of them was the capital adequacy or capital adequacy requirement, and it stands until today. But the definition of or the interpretation of the capital adequacy ratio at that time was much more simple because the risk-adjusted assets that they defined, risk-adjusted assets, only took into account the credit risk. So again, the uh, definition of the capital adequacy calculation, especially on the denominator side, that actually we are going to discuss is one of the sessions that we are going to see about capital adequacy ratio. Risk-adjusted assets that they defined at that time only incorporated credit risk. Okay, so of course our focus today is not about the Basel Accord, but that's the part of the history. In 1988, and it took them about 10 years later, in 1998, when a big crisis hit some parts of Asia and some parts of Europe, to realize that market risk was also important. That's why until as of 1998, they added one more risk into the capital adequacy estimation, and that was market risk. We are going to see in some sessions after this one. Okay, so again, the first type of risk that was incorporated into capital adequacy estimation or calculation was credit risk, right? And this is understandable. Again, if you lend out money to people, right, to people or organizations, that's the most obvious risk that we can analyze, right? Credit risk. So how credit worthy an organization is, right, or how credit worthy an individual is that you're going to lend money to. Okay, so we see here credit quality problems. So it keeps repeating from time to time, right? So 1990s and so forth. But this is something that is very interesting, and we should bear in mind that the financial crisis, because of credit problems, always repeat with a similar course. Of course, we are not saying that uh, they repeat it or they keep repeating because of exactly the same course, but it's quite similar. And what is it? The most common problem that engendered credit risk is property bubble, right? As always, right? Property bubble. So bubble means what? That increasing price, right? You can imagine like bubbling, bubbling something.
They lend money for cheap interest rates from the bank, and then
Mm-hmm.
they make investments like buildings, and then everybody wants to buy to build a house
Mm-hmm.
or buy an apartment, and then the bubble starts to exist
Mm-hmm.
because the prices increase and increase and increase, and the supply is limited. Yes.
Yeah, yeah, that's right. Yeah, you could imagine that the bubble, property bubble, so the prices increase beyond their fundamental values, and exactly what you said, right? The uh, financial institutions got complacent, and yeah, I think it's combination between complacency and greed, right? Greed also plays a role here because we want to lend out money faster to more people, right? And uh, we underestimate the credit risk and something like that. But something interesting here is that from one generation to the next generation, we are doing a similar mistake. Again, we are not saying that it's exactly the same, but similar, right? So 1980s, certain crisis hit, uh, especially in the United States. They called it the Black Monday, that October something, October 9th or something, or October. I don't remember the exact date, but in October 1987, something happened to the capital market, and one of the reasons behind the capital market crash was the property bubble, right? And then in 1990s, we saw a big one, right? In 1998, in Russia, in Asia, and then in 2008, we talked about this several sessions ago. Again, property bubble problem, right? And then the bubble burst or bursted, and then the crisis came. So this shows that if we don't experience the crisis, we might underestimate the situation a bit because we could only read from literature, right, from media. For example, maybe your generation right now, you didn't really suffer from the crisis in like 2008, maybe a little bit, right? You were a little kid, but in the 98, definitely you didn't know, right? You read, of course, you read from newspapers, from textbooks, from literature, but you didn't really feel it. Right? Didn't really, suffer the real life problem intertwined with the crisis. So someday, if you become like a top executive of a bank or any other financial institutions, you might not really uh, take into account the painful experience, right? The painstaking experience from the past, because you could only read from literature and newspapers or something like that. So you see here the problem keeps repeating in a similar fashion, right? The property bubble. So human tends to forget, right? That's what we are trying to say, I think. We try to forget, or if we don't suffer from the real life experience, right? The real life pain, then we don't really, uh, you know, pay attention to the details of such risks, right? Because we see here, uh, like every decade we saw or we see similar property bubble, right? Of course, in some periods, we see other problems as well, like credit card problems, auto loans. This is a big thing in the United States, especially. especially you would be surprised to know for students because if their parents don't pay for tuition fees or monthly stipend, they will borrow, right? They will borrow money. Uh, they borrow student loans, and student loan will be repaid after they start working, and the period of paying would be quite long. They could pay up to I think 15 years, and many students abuse actually the student loans by doing something else. One of them is to buy nice automobile, right? Buys nice cars, and we can see a lot of like transformer cars on campus, right? The Bumblebee. You could imagine, right? You borrow the student loans and you end up buying the Bumblebee. And many of them, of course, couldn't repay their loans, and their cars are confiscated, and they still have to like reschedule their payments and everything. But again, a lot of problems there. But uh, the big one is property problem, as except or besides the credit risk, auto loans, and other things. And you see here crisis in many other countries in Asia. This one in 98 started in South Korea, Russia also 98. And these two countries, you see, they're neighbors. I think Patricio, you're quite familiar with your, not that close, but somehow your neighbors, right? Brazil and Argentina. And Patricio, could you, like based on your experience or based on the news that you read, between the two countries, one of them, I think, learn more from experience and improve better. Which one is that, do you think?
Um, okay. Well, if I need to guess, I will think
Mm.
that Brazil.
Yeah, that's right. Brazil improved better than
Yeah.
Argentina. And you see, Argentina keeps going into like similar trouble, right? Economic crisis. Like every 5 years that you see news that announces a new problem for Argentina and something like that. So obviously they don't really, learn from past experience, like the monetary policy as well as the fiscal policy and other uh, economy related policies, right? Not really improving, not as good as what Brazil has been achieving. Um, but this one, mortgage problem, we talked about this. I remember the mortgage problem, mortgage-backed securities that created a big problem in 2008 to 2010. So this emphasizes the importance of credit risk, right? Credit risk analysis. Again, this is the first, even the earliest risk considered or taken into account by the Basel Committee in their first, even in their first accord. So again, here, what is NPL? Are you familiar with this terminology? Non-performing loans, non-performing. So any idea what it is? You see the name there, non-performing loans. Maybe Clara?
I'm not sure about that, but maybe like when you
Mhm.
give out loans um, which you're not really making money with, so they're
Mhm.
not performing. That's what I
That's
would
right.
guess from the name.
That's right. So non-performing loans, loans that you have provided or you have given, but are not repaying well. And usually the definition of NPL is if it is due more than 90 days, right? So it's overdue more than 90 days. Then usually you define that as a non-performing loan because some of the loans uh, have not been repaid with an offer due of like 30 days because of the forgetfulness. Some of your clients are just uh, having bad mentality. You understand what I'm saying, right? They are able to pay, but they have like bad character. They forget, they underestimate things, they ignore things. So it could be that it's offer due for like 30 days or even 60 days, not because of a fundamental problem with the borrower, but just because of a bad character. But if it's overdue more than 90 days, definitely you consider that a non-performing loan. Or you can call it NPF, another name for it, non-performing financing, right? Just the same thing, non-performing loan or NPF, non-performing financing. Okay, so you see here, early 2000, here problem with tech companies. Now, I think most of you were not born, right? Had not been born in 2000. Uh, but with the emergence of internet, late 90s to early 2000, there was a tech company bubble at that time that also created a lot of crash on the capital market and of course with the financial institution. So do you know that the what year exactly the internet started to be used by common people? Can you guess what year was that when we started using internet for the common people?
End
Any
of 20th century.
Yeah, you know, like any guess, a precise year, 1990 plus, right?
Yes.
Hmm.
The
So
first
beforehand,
email, oh, the first
go ahead.
email was sent in Karlsruhe 1989, I think.
Yeah, I think
On
a bit more than that. Uh, Maybe about 1995 or 94. That's I think the uh, widespread use of internet by common people. So beforehand, only military personnel had access to the internet. So they use it for military only. But since 94 and 95, that's about the first use of email and some websites. And you'll be surprised to know that there were very few websites available at that time. Right? So I remember I had to go to the internet cafe about 95 or 96, and I created my first email, right? And the price per hour was quite high at that time. So I had to ask money from my grandmother to go to internet cafe. And my grandmother asked me, like, what's the money for? And I told her that I was going to internet cafe to check emails. So can you imagine who would send me email in 1995? Nobody, right? Nobody. So it was just a new thing, and everybody was checking email, and actually nobody was sending email because it was very new. Yeah, but the expectation on the technical companies was so high. So at the time, we saw the prices of like Yahoo, right? The stock prices of Yahoo, Google, Netscape. I think you're not familiar with the name, and Netscape Communicator. That was among the first, what's that, the internet surfing website. Now we have Chrome. What else do we have now? Mozilla, Internet Explorer, right? Something like that, right? But at the time we had Netscape Communicator. So all the stock prices suddenly bubbled, right? They got up, they went up like crazy, and finally in 2001 the bubble burst, right? Or bursted, right? So so that was the beginning of 21st century, right? We saw the bubble burst of the tech stocks. And unfortunately, in 2001, we also had a bigger problem, right? The 9/11. So 2001 was really a difficult year for like, the financial markets. And of course, credit risk increased, soared because of the double problems, the big problems in that year. Okay, so mortgage crisis, we talked about this, right? About the 2008, and then increased emphasis on credit risk evaluation. Of course, from time to time, we have more challenges related to the measurement and also evaluation, measurement and management, as well as evaluation of the credit risk. So you see here, what is the biggest one? Real estate. Okay, real estate, the property problem has always dominated the credit risk discussion. And then we'll see some other types of the loans. Yeah, but again, the biggest is always the real estate or property. So we see types of loans now. The first one is CNI. So from what you have read from the text, what is CNI? Alina, what is CNI? What is it?
I didn't turn on the mic.
Mhm. Oh, okay.
I'm sorry, but I hadn't the time to
Okay.
go through this chapter
Mm-hmm.
yesterday.
What is it? It's commercial, right? Commercial. So the I is industrial, so you can say commercial loans or commercial and industrial loans. So we have, of course, secured and unsecured. Uh, most of them are secured, of course, because this is a professional loan, right? Commercial and industrial loans. Most of them are secured. So syndication here, see the name syndicate, it means that we ask another financial institution or another bank to join in giving the loan. And this is becoming more and more common because uh, the amount of loans has increased from time to time. So imagine that you have to lend out maybe 1 billion euros. So let's say actually your bank has the money, like 1 billion euros, but you still feel, that the amount is too big, and the dependency on uh, this client will increase, right? So you don't like it. Imagine, right? If you have a lot of clients, but suddenly one client wants to borrow like 1 billion euros, although you have the money, you'll be quite concerned because now you depend a lot on this particular client because you lend out a lot of money to this one. So there's a big chance that you will invite other financial institutions to lend out the money. So maybe you ask the other two financial institutions to lend out the 1 billion. That's indication. And then here we have two terminologies that you see a lot throughout our next discussions. Spot and commitment. We talked about commitment, right? Yesterday or some sessions ago. What is the meaning of spot? Maybe Dina here. Is Dina here? Yeah, I saw Dina, right? Uh, Dina, what is the meaning of spot? Can you explain?
I don't really know.
Just from the name, can you guess that spot means what? At the spot. So if you say at the spot, what is the meaning then?
At the place.
At the place. So you make the deal right now, and you execute the deal right now. That's why it's on
Okay.
the spot, right? On the spot or at the spot. Right. So you make the deal right now, but you also execute the deal right now. So usually the definition of spot in finance is T+2 maximum. So we make the deal right now, we execute today, of course, that's spot, right? But if you make the deal right now and you execute the deal 2 days from now, that is still considered a spot transaction. So the maximum limit is like T+2. What about commitment now? Uh, Karina, maybe? Karina, any idea? Now, commitment? So spot, yeah, go ahead.
Maybe that you write down the why the qualifications why a person should receive a loan.
You could give a promise such as that. But so the meaning, what is the meaning of commitment compared to sport? So if sport is like you make a deal right now and you execute it right now, but what about commitment?
Commitment would be that you like agree that you would go give a loan in the future, but you're
Right,
not giving it right now.
right. But the deal is made when?
The
Right
deal,
now.
the agreement is done right now.
Yeah, that's right. So you make the deal right now, but the execution will happen sometime in the future or sometime later, maybe within 1 year, uh, half a year or something like that, right? So that's the difference between spot and commitment. So we make the deal right now, but the execution of the deal will happen sometime later, right? Not right now. But for spot, we do it right now. So you see the fact here, commercial and industrial loans originated by commercial banks have been declining. There is a decline here. And you could guess why. A lot of companies, so they have a lot of like opportunities to borrow money from other sources. So you could probably imagine if you ask your, let's say you ask your grandparents, okay, you ask your grandfather or your grandmother, if they do business or they did business in the past, if they needed money, how would they get additional funding? Of course, they would go to a bank, right? Most likely, because that was the fact that was it. That has been the uh, most common source of financing, right, for businesses, uh, even until today. But it was more dominant in the past. But nowadays, you could imagine if you're a company and you need money, you have a lot of other alternative besides going to a bank to borrow money. So what is it? What are the alternative? Maybe Patrick, if you need money, your
Uh,
company needs
uh, a
money.
new
Mhm.
a new possibility is today crowdfunding or something.
That's right. Yeah, crowdfunding. You could borrow through the peer-to-peer lending, right? Or equity crowdfunding. Yeah, that's right. What else? Uh, Someone else maybe.
You could
Max,
with
maybe. Oh yeah, go ahead. Go ahead. Alina.
you could
Alin.
you could you could withdraw the contract if you
Uh,
have a contract
yeah.
to give money to somebody and you need that money from that somebody, you can cancel and withdraw the contract.
Mhm. If you already had a commitment from a bank, yeah, of course you could draw a loan from there, right? Yeah, many other sources. Maybe one more. Max, what do you think, Max? What else can
Yeah,
you do to get money?
you could issue out stocks or shares of your company by
That's
yeah,
right.
to private
Mhm.
persons.
Mm. Even easier ones, you could start from easier ones like commercial papers, because issuing stock would be the most complicated one, right? You need to hire an underwriter, you need to go through the road shows, you have to go to many cities to advertise your new stocks and everything. So that's even the most complicated one. Well, you could start from the easiest one, issuing commercial papers, and then a bit more complicated, you could issue notes or bonds, and of course, the most complicated one would be stocks. That's right. So you see, that's why nowadays financial institution is competing with other sources. See, declining, right? This is declining. And then the effect of financial crisis on commercial paper market. So if we see a financial crisis looming, then the commercial paper and also like bond markets, commercial paper and bond markets would be uh, drying up because not many people are interested in buying. So they would go back and they would rely a lot on the banking system again, right? Especially in the financial crisis, like it is today, right? Uh, we saw some not so good news several days ago that like German economy was contracting right in the first quarter, and this financial crisis would mean that the like bond market would be quite not interesting to common investors. So if you're a company and you need a lot of money, especially in this kind of situation, you would rely less on the bond market, but you go back to the banking system, of course. So this is the first type, commercial and industrial. The second type, what is it? Real estate. This is a famous one, right? Mortgage, right? Real estate loans. Uh, so mortgage. So there are two types, two basic types here: fixed rate and adjustable rate. And you could guess easily, what is that? What's the difference? Fixed rate and adjustable rate again?
That the rate changes.
Mm-hmm. So fixed rate means
It doesn't change.
it doesn't
The
change, right?
interest rate is
Adjustable means it will change, right? And to make the change fair, this will follow a certain index, right? Maybe uh, LIBOR, right? The famous index, or uh, maybe inflation index, or any other indices, right? We'll talk more about this in subsequent sessions, I think. But you see, when we define an adjustable rate, it means that we must have an index as the anchor to become the anchor. Okay, so fixed rate and adjustable rate, and so there's another terminology here, loan to value. So remember this one, loan to value ratio. This is the opposite of what? So you can imagine, right, the amount of loan relative to the value of the house or the building. So this is the opposite of down payment, right? You could imagine, right? Down payment. So if you make a down payment of 20%, it means that the loan to value ratio is 80%, right? Because you borrow, so your loan or your borrowing relative to the value of the asset or the building is 80%, right? So what do you think here? The higher the loan to value ratio, is it riskier or is it less risky? Any idea here? So the higher the loan to value ratio, is it riskier or is it less risky? You borrow more, someone borrows.
Is it riskier because the loan is higher than the value?
Right, it's riskier, of course, right? Because now the amount of the loan relative to the value of the asset is higher, right? So it's the opposite of down payment, right? So if someone makes a higher down payment, then the risk is lower, right? Okay, so you see here, of course, we'll see the third and fourth types after this one. Or maybe we continue first. This is the third type, consumer loans. You see here, consumer loans. This could be used for personal reasons or personal uses. Auto, credit card, and there are two types here for the consumer loans: non-revolving and revolving. So non-revolving means this is not automatically refilled, right? Different from this one, right? You see the revolving one, for example, is credit card debt. If you pay off the balance of your credit card, right, then it's automatically refilled, right? So you could say this revolving, right? So it's automatic. If you pay it off, you can use it again month and tomorrow and next month and so forth. But for the non-revolving loans, you have to reapply. It's not automatic, right? For example, if you buy a car, you take a credit, right? You buy on credit, then you repay your debt for maybe 3 or 4 years. When you pay off your debt, it's not automatic that you could buy another car. You still have to apply, right? You have to reapply. Also, what mobile home, personal loans, and other things. So, can you give some examples of this one? Personal loans. What can you use for like consumer loans? You can buy a car. You can use credit card for many uses. What are the examples of personal loans? What can you do with it?
Make investments in, for example, cars or buildings.
Buildings would be, I think, included in this one. Remember the real estate. If you borrow money for building a house or erecting a building, then it would be classified as real estate loans. But this is more personal. Like what? Simple examples, maybe?
Maybe like paying study fees or something?
Yeah, you could say that. It depends on the. Do you have like student loan right now in Germany? You could borrow to pay tuition fee. Do you have that kind of loan?
I'm not quite sure. I think that we get a student loan for personal reasons when your parents don't earn that much money that you can live while studying.
Yeah, so you could use the personal loans to buy books and everything. Yeah, that's included. Yeah, or you borrow money for traveling, maybe, right? That's also included. Or you buy what else? Electronic devices, right? Laptop, mobile phone, and yeah, other things. Right? So for personal uses, or even to buy clothes, right? Apparels and yeah, other things, personal uses. And here we have the Bankruptcy Reform Act. This also depends on every country, right? Have different law in different country. In some countries, individuals could also declare for bankruptcy. Declaring for bankruptcy doesn't mean that you can automatically stop paying your debt, but it might be like reschedule, right? Postpone or reschedule or something like that. So you see high default rates of this one. This created a lot of problem during the previous crisis. And of course, the same thing will happen, I think, in every crisis. Like today, you could imagine, right? Because of the health crisis, many companies have to stop operations and they have to lay off people. So the people who get laid off, you can imagine, right? They stop having incomes for a while, right? Until the situation rebounds and they go back to work. But before finding a new job or going back to their previous companies, they have to live carefully with the available money, right? If they have a lot of like borrowings or credits, then they will be in trouble, right? Repaying. So they need rescheduling and other things. So let's go back here. We see among the total here, what is the biggest one? So in the United States, the biggest is the mortgage, real estate, and I believe this would be very similar in many other countries in the world, because like human nature, again we need housing, right? And like parents have like two kids, for example, the two kids will grow up, they will get married, and they need new real estates, right? They need new housing and properties. Okay, so this is quite natural. What is the second? The CNI, like the commercial and industrial loans, and then the personal or individual, and then other. And we see the fourth one, other. What is other? See, farm loans, right? Certain countries have big priorities on farming, right? Including the United States, right? Farming. So this gets a huge priority from the government. So farmers could borrow money at like milder terms, like easier terms than other people could. Other loans from other banks, the interbank loans, for example, and then broker margin. So are you familiar with this? Maybe some of you are trading stocks or bonds or something like that. We call it margin, broker margin. Any idea? Any of you are trading stocks here? Not really. So if you want to trade stocks, usually your brokerage firm would allow you to borrow some money. Okay, so it depends again from one company to another, from one country to another. But let's say a more aggressive country like the United States, some brokerage firms will even allow uh, its client to borrow 50% of it. So if I say, maybe let me give you a simple example. Okay, so if there's a brokerage firm here, it's a brokerage firm, and you're a client, and your brokerage firm is telling you that uh, you could buy stock on margin, let's say of 50%, right? So if you put money in the brokerage firm, you put let's say 10,000, you put 10,000 euros, and if you could borrow up to 50%, how much money, how much worth of stocks can you really invest? This is a simple mathematics, right? So you put 10,000 to the brokerage firm, right? And then the broker says that actually you could trade with like a borrowing of 50%. So you could trade up to what? So 50% of X is 10,000. What is it? 50% of X is 10,000. So what is X?
20,000.
Yeah, 20,000, right? If the broker tells you that you could trade the stocks with a margin of 50%, then with investing 10,000, right? 10,000 cash, you could ask your broker to trade up to 20,000. What if the broker tells you that you could use the margin system of 10%? So how much is it? You invest 10,000 cash, and the broker said,
100,000?
yeah, 100,000, right? So it's even more dangerous. You can see the logic there. Some countries are more aggressive. They allow like lower margin. They require lower and lower margin to attract investors. So you could imagine if you have only 1,000, even 1,000 euros, you put the cash into the brokerage firm, and the broker or the brokerage firm tells you that you could trade with a margin system or margin rate of 10%. It means that you could trade up to 10,000, right? With 1,000 cash, you could trade up to 10,000. With 10,000 cash, you could trade up to 100,000. So the lower the margin, the more dangerous, of course, but it's very interesting very attractive to the client because now you could trade up to a very high value by only investing little cash. Right? So here we call it broker margin loans. But in many conservative countries, they will not allow the margin too much, maybe 90%, maybe 95%. So it's not, the borrowing from the brokerage firm is not that high, not significant at all. And you also have other loans here, foreign banks and sovereign governments. So sovereign governments can also borrow money, right? The governments in the world, and you see even in today's situation, many developing countries are borrowing from other banks from other countries. Of course, they could borrow from any other organizations, right? They could borrow from World Bank, right? World Bank, especially for poor countries, they could borrow from IMF if the country is having monetary problem, the currency problem, or foreign exchange problem. Right? You could borrow from IMF, but you could also borrow from another country's financial institutions. And actually, this happened with Greece some years ago. So the Greek government owed a lot of money to Goldman Sachs. Goldman Sachs is an investment bank from the United States, and after the crisis, the Greek government was so unhappy because, yeah, somehow it felt a bit tricked by the big financial institution, and because of the deal that they made before the crisis. Okay, so even a government could borrow from financial institutions from other countries. And here, see, the federal government can borrow money. The municipals or local governments can also borrow money by issuing bonds, right? Issuing bonds. I'm not sure in Germany whether like states borrow money a lot. Like each state, like what's that, Baden-Württemberg, is it borrowing money or only the German government can borrow money? Do you know? Only the federal government or states can also borrow money?
I mean, they also do international transactions, the regional state banks.
Okay, maybe they could borrow money. I'm not sure, but yeah, it depends on the country. Yeah. But in the United States, of course, the federal government and also the state governments could borrow money by themselves. So you see that in the US, some states even went broke, right, or close to going broke from time to time. So going back here, and we see that the other is about 17%. So again, the biggest is property or real estate. And within the real estate loans, we see that the most dominant lending is for 1 to 4 family residences. This is also natural and common in many places, I think, because nowadays family has like fewer kids, right? Maybe 1 or 2. Not sure in Germany, maybe 1 point something. What is the average number of children nowadays? 2 or maybe below 2, I think, right? 1 point something maybe, like in many countries. And you see multi-family residences is not that high, right? 5.1%. And for commercial buildings, it's about 29 or 30%. And for farming buildings is 2.1. So again, the biggest is allocated or borrowed by 1 to 4 family residences. And actually, this is very important. I just read the Wall Street Journal yesterday or 2 days ago. Has a difference in that the number of people in one residence actually affect the severity of the COVID-19 in New York. I see for example, in Bronx compared to Manhattan. In Manhattan, they have like fewer people in the residence compared to the situation in Bronx. That's why the number of victims, the fatality rate is higher in Bronx, right? So again, I think this would affect the future thought of young people, right? When they uh, separate from or they get out of their parents' houses, they'll start their own residences, they start their own life in a new city with new residents, and they get married and so forth. So I think the trend again would be here even more and more in coming years because of the fewer residences, fewer members in one residence. Okay, so see some statistics. Bigger banks in the United States, I think Germany. So you can talk about like Deutsche Bank, the DB, very big one, has branches everywhere in the world. For the United States, of course, we have the Bank of America, then Citibank, right? JP Morgan Chase, some big banks. And you see the charge off here, charge off rates. It means that you just write it off, right? So what is the biggest credit card experience, the biggest charge off? Or you can call it write off, right? So they don't pay, you just think that it's impossible to ask from them because maybe they go broke entirely and something like that. So what's the second one here? Second one, so personal bankruptcy filing, right? And then this one is commercial loan. So commercial loan charge off is the lowest, and this is understandable, right? Because when you lend out money to corporations, I think the analysis would be more complete because you have more data, right? Imagine like a company comes to you and you are doing the credit analysis on the company. Of course, you have more data, more information, and you could conduct a more proper survey on the company. You could interview more people and so forth, right? But if an individual comes to you, of course you ask for a lot of documents from the person. You try to do a survey. You might call a referee that he or she mentions on the application form and so on. But still, the quality of data, the quality and quantity of data might not be as good as those for corporation loans, right? That's why the corporate loan charge-off is lower. or the lowest in this case. And the consumer loan here, personal loans, like you see car, auto, and then other personal loans, right? The common ones. Okay, any questions before we continue about the credit risk, like the concepts and also maybe recent development, like you could imagine. And this will always be, again, the core of banking, a financial institution, because I think that's the nature of your business, right? Lending out money. But here's the I think, a bigger challenge to a conventional bank or financial institution is the emergence of fintech, financial technology, like what Patrick mentioned, right? The peer-to-peer lending, even equity crowdfunding, and some other fintech or financial technology forms. So you could imagine, like in the past, the smaller borrower, like individual, they have to go, of course, if they want to start a small business, they have to go to a bank to try to borrow money. But now they could go online, right? They could find the peer-to-peer lending, and they could borrow maybe up to, I don't know, maybe 20,000, or if maybe more, right? Maybe 200,000. I don't know, the maximum amount in every country is different. But fintech is a different topic of its own. But we have to know that the challenge has been quite, yeah, quite tough to financial institutions, right? Because now, not only do you compete with other banks or other financial institutions, but now you have a new form of institution, right, that relies on technology. And there's a big lesson actually that financial institutions learn from the transportation. You know that among the technological firms that we are seeing today, I think one of the first that appeared was transportation business. I think you're quite familiar with Uber, right? Uber, and then it has other, other names, other brands in many countries. But you see, when Uber came to existence, there was a lot of resistance, unhappiness from the traditional taxi companies, right? So they got angry, so they tried to do the like one-on-one fight business fight, right? One-on-one business fight with the Uber or some companies like that. And it turns out that they couldn't fight with technology, right? Because technology will win because of the flexibility and the ease, right? Also everything is easier. So this is, I think, the mistake made by the conventional taxi companies, right? So they didn't really want to cooperate, right, or somehow collaborate with the technology from like Uber, but they chose to fight, right? So again, the business fight, one-on-one business fight, and they couldn't win, right? And I think this has been learned by financial institutions. So the second wave came, right, to financial institutions, and banks were seeing a very similar situation. If they fight, or they let's say they try to lobby the government to kill the fintech companies, I think that will never happen. We cannot fight with technology, right? We have to adapt, and of course we have to harness the technology. So we see a lot of banks right now, they try to acquire fintech companies, or at least they try to collaborate, right? They try to collaborate or cooperate. So for example, like a bigger bank in Singapore, like DBS, right? Development Bank of Singapore. So the bank itself is a giant in the country, in its country, but now it's also looking for fintech companies to serve like smaller individuals or retail loans, right? Rather than fighting directly with those fintech firms, it's better to acquire them or even to collaborate with them so that we could take the benefits as well, as much as possible from the technology. I think that's the fact that will change the face of the conventional financial institutions. So rather than fighting, rather than trying to lobby the government to kill the fintech by regulations, that will never succeed, right? Because we're never able to fight with technology. But you need to know that every country has different policy on the fintech. Uh, we start from, for example, in the United Kingdom, okay? So they choose to make a different set of regulations for the fintech firms. So we could say that this situation creates a bit more difficult situation for fintech because now you have a different set of regulations. The United States asked the fintech to follow whatever regulations they are having. So if the fintech firm is doing business in like banking or peer-to-peer lending, then they have to follow the Federal Reserve regulations. If the fintech firm is doing transportation, then they have to follow the transportation regulations and so on. So you see the UK is making a new set of regulations. The United States is asking the fintech to adapt or to just follow whatever regulations they are having. What about China? China cut the regulations for fintech firms. So it becomes very easy, right, for Chinese fintech firms to get financing, to operate for other things because they cut the regulations. So which one is the best? It's hard to say. Only time can tell, okay? But you see the logic here, right? For the case of China, because they cut the regulations, this will make this will give a lot more like flexibility and ease to the financial technology firms, so they could go faster. So potential is higher, but the risk is also higher, right? So if the experiment is successful, then the Chinese fintechs will enjoy first because they get a lot of like again the regulation cut, right, from the government. So it's very easy for them or easier for them to grow and to improve. But if something bad happens to the system, then they will die first. They will go broke first, right? So always the two sides of the story, right? So if it is successful, then they will enjoy it first because they have the most flexible regulations. But if something bad happens, then they will go broke first, right? And this could bring a big problem, right? Could imperil the country as well. So I think there's something new that have to be taken into account, right, to the financial industry, financial markets. Any question before we see the quantitative part now? Okay, so now we'll see the return on a loan, right? We can estimate how much return you can earn on the loan, right? So we see a formula here, right? So explain the logic. So when we estimate return means yield, right? Or what's that, result, right? Return on your investment. So the common logic is always how much proceed you earn relative to the amount of investment that you make. Okay, so return is always proceed divided by investment. Now the thing is, every investment will have different forms of proceed. Right? For example, Patrizio, if you put your money in a bank, like as let's say time deposit, what kind of proceed will you get?
What kind of proceed?
Yeah, if you put your money as a time deposit in a bank, what will you get?
Depending on how much time I leave the money, right?
Yeah, that's right. But what is the name of reward that you get? You put money in a bank, what will you get?
Interest rate.
Yeah, interest. Yeah, interest income, right? So
yeah, interest.
That's right. So if you put your money in a bank, then the proceed would be in the form of interest. So let me continue with the other Patricio, Patrick. So yeah, so if you let's say you buy a bond of a company, so you buy a bond, right? You invest in bond. What are the forms of the proceed? What will you get? If you buy a bond, what will you get? We talked about it yesterday, remember? You get
Yeah.
every period, what will you get?
Yeah. Yeah.
It's the coupon payments, right?
Yeah, the coupon. Yeah, that's right. The coupon, yeah. And the second one is, of course, you want your bond price to increase, right? From time to time, right? You don't want your bond price to decrease, right? You want your bond price to increase. So we call it gain. So you want capital gain. So this is an increase in price. So two types, right? So the proceeds will be like the coupon income and also the capital gain that you expect. So who else? Clara, wait, Clara, if you buy a stock, what are the proceeds?
It's also interest payment.
Yeah, but
Is it?
we don't call it interest. What is the name for?
I don't know the exact name
Yeah,
for that one.
dividend. Yeah. Yes.
Yes, yes.
Uh-huh. And then also,
You will also get capital gain.
yeah, that's right. You also expect for increasing stock price, right? So again, the my point here is that every investment, return on any kind of investment can be estimated as a proceed divided by investment, right? But now the proceed depends on the type of investment that you are doing. So now we are talking about return on loan, right? So you're giving a loan to an individual or to a company. So I'll start from the investment one. See here, the denominator is investment, right? The numerator is proceed. So let me start from the bottom one. Right? So I have the terminology here, reserve requirement. Uh, 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 is anyone familiar with the term here, reserve requirement? So this is quite a technical terminology in like central banking, right? So if you're a bank, you are required to put certain percentage of your core deposits in the central bank. So let me ask you to imagine, right? You receive deposits, right? Deposits from our depositors, right? So not all of the deposits can be lent out. Not all of them can be lent out, but there's certain percentage of this that has to be invested or has to be put in the central bank. So we call this one reserve requirements.
It's also in Basel 1, this case that you have a security of 8%.
Yeah, it depends on like every country regulation. I think in Germany it's quite low. If I'm not mistaken, it's about 1%. Is it?
The Basel 1 regulation is
Oh,
80%,
that's
but it's
different.
for the
Mhm.
EU, for the European Union regulation.
The Basel regulation is for capital adequacy ratio that we are going to see in subsequent session. But this one is a reserve requirement enacted by the central bank. So, for example, in the United States, this is about 10%. It's very big, right? Can you imagine if the central bank tells you that you have to keep 10% of the deposits into the central bank, into your account in the central bank, that means that you could only lend out about 90%, right? Of this. Right? So it's quite painful for the financial institution to have a big reserve requirement. But again, every country will have different figure. I'm not sure about Germany, but I think last time I saw it was very low. It was about 2 or 1% in the ECB system. Some other countries will have like 4.5%. For example, in Indonesia, the reserve requirement is 4.5%. Right? And it has that several layers, like domestic currency, then foreign currency, and something like that. So it would be different from one to another. But we'll see this more in the liquidity risk next week. Yeah, so I hope you understand now. This is a percentage of the deposits that come to your bank that has to be deposited or has to be put in the central bank. So now tell me, if I ask you, what is the meaning of 1 minus reserve requirement then?
It's the amount of money you can lend out.
Right, that's right. So this is the proportion of the deposit that you could lend out legally, right? The 1 minus reserve requirement. Okay, so again, reserve requirement, this is the amount of money out of the deposits, right? The percentage of the deposit that you have to put in your account in the central bank. So 1 minus reserve requirement would be the proportion that could be lent out legally. And then I have another terminology. We could call it B, or maybe another name, right? We call it compensating balance. Compensating balance, right? So this is the opposite of the reserve requirement. So now when we lend out money to someone or to a company, we require the company to put certain percentage back into its account in our bank. So we are doing like the opposite thing as the reserve requirement, right? For example, you have a client that comes to you, and the client wants to borrow 10 million euros, okay? And then after doing the credit analysis, you decide to lend this company 10 million euros. But you are saying this: we have a regulation, right? You sign the contract that says that you need a compensating balance of 5%. What does it mean now? You lend out 10 million, but the client has to keep, how much is it? 5% of 10 million? 500,000, right? So the client has to keep 500,000 in its account in our bank. So the client could only take home 9.5, right? 9.5 million. But again, the lending is 10 million, right? So we lend out 10 million, but the contract requires the client to put back 5% of it into its account in our bank, right? So this is the opposite of reserve requirement. Right? So now tell me, if I ask you, what is 1 minus reserve requirement multiplied by compensating balance? What is the meaning then? So this is the amount of or the proportion of money that could be lent out legally. If we multiply by B, we multiply this by B, then what is it?
That would be the amount that would be in account in our bank.
That's right. Right? You see, now this would mean the proportion of money that could be lent out legally, but will stay in its account in our bank. Right? Can see it, right? 1 minus reserve requirement is again the proportion of money that could be lent out. If we multiply this by compensating balance, it means that this is the proportion or the amount of money that will stay in our bank. What about this? 1 minus all of those.
I think it's the amount of money we're actually giving out.
Very good, right? Very good. So 1 minus all of this would mean this is the again, the proportion of money that really goes out, right? That's why we see here again, how much investment that you really made or you really make. See, in our context here, this would be the real proportion or the real amount of money that you lend out, right? So one more time, right? 1 minus reserve requirement is the amount of money or the proportion of money that you could lend out legally. You multiply it by compensating balance. This would be the amount of money that you could lend out legally, but will stay in our client's account in our bank. So 1 minus it would be the real proportion of money that really goes to the client. Okay, so it's quite.
Do you mean the net outflow?
Yes, yeah, you can call that way. Yes, Aline? Oh, okay. Yeah, so yeah, that's the outflow, essentially the outflow. What about the proceed here? Proceed, can see this could be like could take many forms, right? But the basic one would be this. This is the interest rate, right? So the interest rate, the basic rate, yeah, basic rate could be, you can use like risk-free rate, right? Risk-free rate or anything plus premium. So the premium depends on the client's risk, right? The level of risk of the client, right? The higher the risk, the higher the premium. So basic rate plus premium. So in combination, this would be the interest rate that we will charge on our client, right? So risk-free rate will be different again from one country to another. In the United States right now, it's about 0.6%. I think in Europe it would be similar, maybe 0.5 or 0.25. Right? In other countries, it might be bigger. So it depends, right? But premium depends on the risk of the client. Right? And then you can add other things. Maybe you can call it admin fee, right? Certain percentage point as an admin fee, or I think the text call it origination fee. You can call whatever name you want. So essentially, like the additional fee, and this is very important to a financial institution, right? Because we cannot like deviate from your competitors' interest rate. Can you imagine, like let's say team, you and Aline, right? You are competing banks, right? One from another. So for, let's say, the same level of client, okay, the same client comes to team, and team is quoting an interest rate of, let's say, 5%, right? 5%. So if the client, let's say Karina is the client, okay, so Karina comes to Aline, right? And of course, knowing that team, right, a competing bank, is willing to charge 5%, it's very difficult for Aline to suddenly charge at 6%. Why? Right, Aline, if you charge Karina 6%, whereas team charges her 5%, what will happen?
I have problems in financing it.
Karina will not borrow from you. That's the easiest way to imagine, right? Because team is charging 5%, right? And you try to charge her 6%, then Karina will not borrow from you, but she will borrow from team. So what happened here? You have to charge approximately the same interest rate, right? So knowing that team is charging Karina 5%, then you will charge Karina about the same interest rate to make you competitive. But you could do it like a more subtle strategy to earn more money. For example, you tell Karina that, okay, the interest rate is 5%, but you have to pay like admin fee, right? Whatever the name, right? Origination fee or anything of 0.1%. That really makes a difference, right? Can you imagine 0.1% multiplied by 10 million? It's quite a lot of money, right? I know the number seems small at 0.1%, but if you multiply 0.1% by a big number, then it's quite good money. So you could use that strategy. So if Karina going home and maybe she meets Dina, okay, Dina is her neighbor, and Dina is asking Karina, how much interest rate does Aline charge you? And Karina will say 5%. But actually, you charge her additional like origination fee or admin fee or something like that. But again, if someone asks her, then she will say that it's 5%, right? But actually, you have like admin fee and other things. So this is an important strategy to a financial institution. Right? You can charge additional origination fee or something like that. So let's see an example now. So what is the interest rate here? Basic rate is 6, premium is 4. So the interest rate is 10, right? So you charge the client 10% for the interest rate. But now you also have this one, you see, origination fee, 1/8, 0.125%. And then what do you have here? Reserve requirement. Reserve requirement in the US is 10%. And then the compensating balance requirement that you impose is 8%. So we just put into the calculation here. So starting from the denominator, so reserve requirement is 10%. So 1 minus reserve requirement is 90%. Agree, right? So this is a proportion of money that you could lend out legally, right? 90%. And if you multiply by the compensating balance, so this would be, what is it again? The amount of money that you could lend out, but will stay in your bank, right, as a compensating balance. And 1 minus all of this would be the real money that goes out, right? The real investment that you make, or the real money that goes to the client. What about the numerator here? We have the interest rate at 6 plus 4, basic rate plus premium, and then you have the admin fee or origination fee of 0.125. So you get 10.91%. This is the approximate return that you will earn on this investment. Any question about this? Right, quite straightforward. Again, proceed divided by investment, right, as always. The amount of proceed that you get divided by the investment that you make. Any question about the calculation? I hope it's quite clear. So before we go further, the retail versus wholesale credit decision. So what is the difference? Retail means what? Individual, retail, smaller loan, right? So retail or individual loan, and the opposite is wholesale. See the name, right? This is quite famous terminologies, both of them, retail and wholesale. The wholesale is talking about the bigger loan to an organization or a company rather than individual. So you see at retail, now we start from the retail. So accept or reject decision, credit decision is usually, we're not actually, we couldn't say more simple, but I think more straightforward, right? More straightforward, so clear, right? And most likely you use the credit rationing rather than pricing. So here's the logic, right? Credit rationing means that you try to determine the amount of money that you will lend out to this individual, right? So Tim, again, you're a bank, right? So let's say Patricio is coming to you, right? Patricio is an individual, right? He comes to you and he says that he wants to borrow maybe 200,000, right? He wants to borrow 200,000 from you. And what again, what will you do, Tim, if Patricio comes to you, he wants to borrow 200,000? What will you do first?
I will make a credit analysis first.
Credit analysis, right? You do the survey, you interview him, you will call the referees that he mentioned or whatever, right? And if you want to, let's say, you think that Patricio is not bad, right? But not really, not really attain to the credit worthiness that you want. You understand what I'm saying, right? It's not a bad, not a bad candidate, okay? But you don't think that he deserved the 200,000 loans, right? So there are two possibilities, right? Two possibilities. First, to reflect the level of risk, you could charge a higher interest rate. This is the first possibility, right? Second possibility is you charge him the same interest rate as the rate on someone else, right? Typical person. But now you decide not to lend him 200,000, but you are willing only to lend him, let's say, 150,000. So my question is, for a retail investor, which possibility is more feasible? What would you do, Tim, if this is the case for you?
Hard question. I don't really know, to be honest.
Yeah, just use your logic, right? So this is an individual. The first possibility is you charge him a higher interest rate because you think that his level of risk is higher. The first possibility, right? You charge a higher interest rate compared to other people. Second possibility is you charge him the same interest rate as a typical person, but now you decide not to lend him 200,000, but you are willing to lend him only 150,000. Which one will you choose?
I think the one with the higher interest rate.
Okay. Yeah, you could choose that way, but most likely you will not choose that way. I mean, for a typical bank, there are several reasons that now you could imagine, okay, why you will not choose the first alternative. So most likely, team, you'll choose the second alternative. So you will charge the same interest rate, but you will adjust the quantity of your lending, right? So you think that Patricio is a bit riskier than what you expect. So you will lend him only 150,000 or 100,000, but you will not change the interest rate. Why? Because there are too many people. Can you imagine, Tim, if you have like maybe more than 10,000 people coming to you every month, and if you decide to differentiate the interest rates for many people, what will happen to the bank? Not enough resources. Yeah, you want to say something? Okay. Right? So too many people to handle. So it's almost impossible to define the interest rate for everyone. Right? If there are like more than 10,000 people coming to the bank every month, right, to apply for borrowing or apply for loans. But secondly, this is very important one. You might get into some law problems, right? Because now maybe the person could get angry and could sue you to the court because of like discriminatory practice or anything, right? You understand what I'm saying, right? So of course we don't have that intention, but this could happen, right? So we charge, for example, this certain person, let's say 6%. You charge another person 5%. You charge another person 7%. You charge the other person 4%, and so on. So those people who are unhappy could sue you to the court because they could say that, okay, you are doing discriminatory practice, right, by charging him or her a higher interest rate. Okay, so you don't want that to happen, right? It's too complicated. That's why for a retail investor, most likely you choose the second alternative to do the credit rationing. You see here, credit rationing, right? This is more likely for a retail investor. On the other hand, for the wholesale investor, you could use both. Okay, you could use both. Again, for wholesale, you could use pricing, different interest rate, but you could also play with the quantity or amount of loan that you're going to lend out. Why is that? Anyone? For the wholesale client, you could adapt both different interest rate and also different quantity of lending. Max, maybe Max, you want to try?
Yeah, I don't really know. Maybe it has to do with the quantity of loans they give out. So if
yeah, you can do
own...
both.
Yeah,
for
yeah,
the
but
wholesale, yeah.
Yeah, but there is not that much comparison, and the loans aren't as frequently as the other loans.
Yeah, that's correct. Yeah, that's true. So you don't have as many clients as the individual clients, right? Now you have more time to do the credit analysis, right? So that's the first. And secondly, you have more reasons to differentiate the interest rates on companies. You have more evidence, right? So Tim, when you did that for retail investors, there's maybe many of them join effort and sue you to the court, a class action. You'll be in trouble because you have to prepare a lot of like evidence and everything, right? Individual evidence. Can you imagine how complicated it is? But for companies, you could easily collect data to show the proof and everything, right? So that's why for wholesale, it's more flexible. You could do both. You could use the quantity differentiation, but also the interest rate differentiation. Okay, so credit scoring model. Maybe one more before we finish the session, okay? So we have two types of models, right? Let's start from this one, qualitative model. So qualitative model, as the name suggests, is qualitative, not using any numbers, but using the qualitative factors. So there are two factors here. The specific factors, specific means this is related only to the individual or the company. The second factor is the market or systematic factor. So specific, you could imagine, I think we talked a little bit about this. If you have a client, right, you have a client coming to you, the client carries a specific factor, right, related to the client, both individual and also the wholesale or the company. Right? For example, if you have like several clients coming, and let's do example here. Tim, again, you are the bank, okay? So we maintain you as a bank. You have, let's say you have simply two clients. You have Dina and Clara, okay? Dina and Clara, two clients, and both of them have plants, factories. So simple example, right? If Dina's factory or Dina's plant is burned down by fire, what about the plant of Clara? Is it burned down by fire as well?
No, it isn't.
Shouldn't, right? It shouldn't be. Right? If both of the factories are burned down by fire, it means that somebody is burning both of them, right? So it's like a crime. But in normal business logic, we know that if something specific happens to Clara, it might not happen to Dina at the same time. That's why we call it a specific risk. Right? Specific risk. Or maybe you lend out the money to both of them, and it turns out that Clara goes broke, right? She goes bankrupt, but Dina doesn't, right? So this is specific risk, right? Specific risk, because what is happening to Dina might not happen to Clara at the same time. So you can extend the example. But what about the second one, the market risk or systematic risk? So this attacks everybody in the system. Let's say all of you here are the clients of team. So what is happening to Alina will also happen to Max, will also happen to Patrick and everybody else. Give me examples again of this type of risk. Everybody suffers from this risk.
Maybe a financial crisis.
Financial crisis, that's right. What else? Maybe 2 or 3 more. Financial crisis, what else?
A pandemic like the coronavirus pandemic.
Health crisis, financial crisis, health crisis. But what macroeconomic indicators that you know? Inflation, what else? Inflation risk. What else? This type of risk that will attack everybody in the system.
I think next to inflation, deflation is also a problem because the firms and companies don't invest and don't borrow money, and especially some banks or firms can't make money because they don't get money from interest rates and loans.
That's right. Inflation, deflation, and then you could mention what else? Interest rate risk that we just saw right yesterday. Interest rate risk, foreign exchange risk, right? And then political risk and all other things. But you could imagine there are 2 types of risk, right? The first one is specific, right? So what is happening to one client might not happen to other clients at the same time. That's why it is called specific. See the example between Dina and Clara. But for the market risk or systematic risk, everybody in the system will suffer from the same risk. Inflation, deflation, interest rate risk, foreign exchange risk, the pandemic, financial crisis, and other things. Right? So we have here qualitative factors, right? So it covers 2 types, specific factors and also systematic or market factors. Right? So you see here, the specific factors would be this one, borrower specific. This is borrower specific factors like reputation, right? See our example before between Dina and Clara, right? Different reputation, different leverage level. This is the debt ratio. So debt ratio is the use of what's that, the level of borrowing right now that the company is having or the individual is having. And then the fluctuation of earnings, fluctuation of income, and then the collateral and other things. Okay, so borrower specific factors, right? This is specific factors. To make it easy, I think you might have heard this terminologies before, like 5 C's, right? 5 C's. You have what's that? The capital of the client, right? Right, capital, and then capability. What else? Anyone? Capital, capability. Anything else? Collateral. Characters. Where's the other C? We have 4. The capital, capability, collateral, characters, condition, right? Economic condition. Okay, so this is like the conventional wisdom, right? You can call it conventional wisdom in like giving loans. So borrower specific factors, except this one. This is the systematic part, but for others, company or borrower specific factors. And then we have borrower specific. We have market. This is not specific. Market factors or systematic factors like the business cycle, interest rate level, and what Alina was mentioning, the deflation, inflation, right, and all other macroeconomic situation. It also, if you think about it, some clients are actually quite good, right? Okay, Tim, you are again the banker. If Dina comes to you and it turns out that Dina is a good candidate, right? A good potential borrower, but you see the situation right now, because of the pandemic, right, the health crisis, and that leads to financial crisis, you might decide not to lend out the money to Dina, not because that she is, not because she is not a good candidate, not a good borrower, but because of the condition, right? So your decision is also affected by the systematic factors besides the borrower-specific factors, right? Okay, and so this one is the models, qualitative models, and in our next session, we'll talk about the quantitative models, right? With the some models, like from regression model to term structure of interest rate and some other factors, and also the option model. Any question for the qualitative part today? Okay.